A major country nears collapse. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story, that major country's risky gamble could plunge the world into the next crisis. And what I want to understand is the last time this country did this, they sent global equity markets crashing and nearly kicked off a globally synchronized recession. And yet, at the time, there was only one thing that saved the world. But this time, as you're about to see, there's nothing stopping us from heading into the next crisis. Plus, we have a sponsor for today's show. Spectre Holdings is back. You can find them on the NASDAQ under symbol SPEC. And we think big things are coming for this company as countries around the world continue to raise their carbon taxes. And Spectre helps companies save big on those taxes. And that's why they've seen unprecedented demand at a level they've sold out completely on their products. And of course, on the back of that, we also note that the Biden administration is rolling out the toughest ever limits on pollution, which is going to send companies like Spectre stock through the roof. We think it could double in value, and as you're about to see, the initial move of 35% could come very quickly on the back of virtually any news. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where we picked today's story up with a headline: is China's 55 billion loan surge points to a national team rescue. And this is a huge, risky move as China looks to borrow massive amounts of money in an attempt to prop up their equity markets. Now, they did this once before, and the challenge with borrowing money is if it doesn't turn into growth, if it doesn't have a positive effect, well, it just burdens the economy even more and causes the next crisis to be even deeper. And that's the challenge here, because again, the last time Beijing did this, it didn't work at all. And loans to non-bank financial institutions, including brokerages and mutual funds, grew by more than 400 billion yuan last month. That was the biggest jump since July of 2015, around the last time the so-called national team of state-related bodies bought up equities to stabilize turbulent markets. And as you're about to see, back then it didn't work. In fact, it had such a negative effect, it caused global equity markets to outright crash, and that was dangerous. But China thinks it works this time, as their non-bank financial institutions usually don't have so much borrowing need. In fact, they really don't. And he attributed the increase to the national team likely borrowing, again on margin now, from commercial banks to buy equities. And that is dangerous, because if equity prices continue to fall just like they did back in 2015, well, that means these companies are going to be saddled under massive amounts of debt that they have no means to pay back. And China took various efforts earlier this year to stem a 7 trillion slide in mainland and Hong Kong stock markets, which became the world's acute symbol of depressed confidence in the world's second largest economy. There's evidence that state institutions, including sovereign wealth fund Central Huijin Investment, snapped up shares to bolster market confidence, and it didn't really work. In fact, we noted this. We talked about this to our subscribers. We talked about this on our show. It gave us a boost in Chinese equities. In fact, many of our subscribers took advantage of that and made some money, but it didn't last. And we said that wasn't going to happen. And sure enough, we're already starting to see the initial effects wear off. And non-bank financial borrowing back in July 2015 surged by nearly 900 billion yuan, a record in data going back to the beginning of the year, which still stands today. And that coincided with the government's attempts to stop the market's violent crash that year. Goldman Sachs estimates a total of 1.5 trillion yuan was spent buying shares between June and August at that time. And you would think with that kind of money pouring into the markets that it would have to work. But we know time and time again throughout history, whether it's central banks or governments trying to intervene with the economy or the equity markets, it just doesn't work. And sure enough, what happened, they came in here to put a floor in the market. What happened is Chinese stock markets continued to crash and fell by another 25%. And while many people today believe the U.S. equity markets are immune to what's going on in the world, we've talked about on prior shows how everyone is long this U.S. market. And not only that, but they're leveraged. The machines, retail investors, institutions, hedge funds, everybody is deeply long this market. market. And last time China's equity markets fell apart, well, we saw a massive rapid plunge in U.S. equities. We talk about a catalyst that could cause the U.S. equity markets to unhinge. Well, it could start with China's move here that will likely not work at all. History has shown us it doesn't, because if you look underneath China's economy, they're fixated on trying to prop up the stock market, but what they can't seem to fix is what's going on inside their economy, and that's why no amount of money pouring into stocks can fix the problem. As China's youth unemployment now rises in February after data revamp, and what we can note, at least here in the U.S., when policymakers revamp the data, usually it looks better. In the case of China, well, it didn't, as the jobless rate hit 15.3% last month for people between ages 16 and 24 years old. That was higher than the 14.6% rate recorded in January and the 14.9% figure from December, suggesting, as we've noted, things in the second largest economy continue to get worse. And that was the first month the rework statistic was published after policymakers spent months tweaking their methodology, suggesting that perhaps China's youth unemployment may be even worse than what they're actually telling us. And this is dangerous because as more and more people hit the ranks of the unemployed, their spending naturally goes down. And in an economy, no matter how much money you pump into the equity markets, eventually what happens is stocks react in a violent way to the downside as growth in the economy gets eviscerated. The U.S. jobless rate overall has climbed in recent years as the job market has deteriorated. Employers have to pull back on hiring, suggesting again, no chance these kids are going to get work, because the key part is the market has deteriorated. That means demand is falling, and that's exacerbated a structural mismatch as graduates primarily seek white-collar jobs. And here's the key thing that we talk about around the world is factories struggle to hire. And if factories are having problems, that means global demand is falling. And again, China is the world's largest exporter. Their factories are the key base of production for the world. So if they're seeing demand at their factory level decline, what that means is the rest of the world is slowing down and heading into a recession. This sets up the challenge of what kept the world out of a recession back in 2015, 2016, and why this time there's no chance that we can stop what is coming. And here we look at China's housing market. It gets worse, and you think that Beijing would focus on the things that would turn the economy around instead of the equity markets, as China's home price slump persists even as support mounts. And this is a problem because if you look to get people to buy into the housing market, well, the one thing you need to do is stop the decline in price, as arresting the slump in values is key to reviving home buyer demand, which would help developers by providing much needed cash to repay debts. The liquidity crisis reached another low as state-backed China Vanke, the country's second largest developer by sales, fights to avoid its first ever default. And we told you there was going to be a cascade of defaults in China's property developers. It still hasn't happened yet, but as you're going to see here shortly, there are more evidence that the tipping point is about to be breached when that happens. Of course, we know their banks are going to go, and now we know that the banks are pumping money directly into the equity market. That's going to go too. You can see there's nothing stopping China from heading into an all-out crisis as new home prices in 70 cities, excluding state-subsidized housing, fell 1.9% from a year earlier, steeper than January's 1.2% drop. They said 0.3% from January when they retreated to mere 0.37%. Existing home prices dropped 5.2% year on year, worsening from 4.5% in January and falling in all 70 cities. Keep in mind, not one person thinks this can happen in the U.S., and we keep making the case of where China is headed. The rest of the world will eventually follow. It's all about demand, and we continue to see demand declining in every major economy. And Chinese authorities, doing little to stop this, have been trying to step up support for the housing market, but doing the wrong things by urging banks to provide financing for developers and allowing local governments to ease rules for home buyers under the assumption that if they can make these home builders solvent again and make it easier for people to buy, they will. The challenge is you go back to the unemployment data and people that are out of work, well, there's one problem. They can't buy houses, or anything for that matter. And that is yet to revive new home sales, which slumped 60% last month from a year earlier, as China Vanke posted its biggest sales decline in 6 years, suggesting that everything Beijing is doing to prop up its economy is not working. We said it wouldn't work because they're not doing the critical piece here and it's focusing on things to turn their economy around. They're putting all their effort into the wrong point. Meanwhile, they see more and more people join the ranks of the unemployed. And what that's causing, well, is the builders to go insolvent. As China's builders tackle restructuring as crisis enters a new phase, we said this was coming, and sure enough, at least 23 Chinese builders or related companies have so far received wind-up petitions in Hong Kong from creditors since the beginning of the real estate crisis. Now, if you're not familiar with what a winding up order is, this is a forced liquidation. This says you owe your creditors money, either you pay them immediately or they're going to sell off your assets to reclaim their money. This is a forced sale. This is not good because we noted that this happened to one company, then a second one. The issue here now is you start to have 23 companies getting winding up orders, forced to liquidate assets. You want to find out where the floor and prices are. Well, dump a bunch of things on the market quickly and it'll happen. And at least so far, 5 of them have been ordered to wind up and liquidate. And this is all coming back to Chinese consumers, which have no demand here as they lose their jobs and they're seeing their economy head spiraling down. Is Keirin's Gucci warning wipes $7.9 billion off market value. Now you might wonder, what does Gucci have to do with Chinese consumers? Well, everything, because the Chinese consumers love Gucci. And right now, they've got no money. As the stock dropped as much as 15% in Paris trading, as the company blamed steeper than expected sales drop at Gucci in the Asia Pacific region. There's your key of China. The fashion group has been trying to revitalize the Italian label. The problem is consumers have no money. And Chinese consumers, once major buyers of global luxury goods, have been tightening their purse strings as the real estate crisis and job insecurity hurts confidence. And we talked about how this starts to spiral out of control as consumers cut back their spending. Well, it leads to more job losses as other companies see demand for their products and their revenues decline. Next thing you know, it just starts to slowly at first, and then it spirals all out of control. And as we look to the U.S. data here, we see the same exact effects as many people still buy into the no landing or soft landing narrative. The problem here is the ranks of the unemployed continue to be sticky around 1.8 million. Now, historically, you see here continued claims in red. That's very low, but that's coming off an extremely low level of around 1.2 million, suggesting there are 600,000 people now receiving ongoing unemployment claims, and many people believe, well, they don't matter. Well, their spending does matter. If you want to keep the growth of the economy at its current pace, you need everybody producing as much as they can. You go back to 2015, 2016, what was the difference maker in the global economy? Well, continued claims in the U.S. was falling. It was the U.S. economy that pulled us out of the slump, but you can see retail sales go down as continued claims continue to stay high or elevated in this case. That means, of course, as demand in the retail space goes down, more people lose their job. But back in 2015, 2016, again, the U.S. pulled the world out of the recession that was just starting. This time, it's not going to happen. And that means the PBOC is going to have to do something that is trying to avoid. In fact, central bankers around the world are trying to avoid because they believe the data in the economies are turning around. We keep making the case where it's about to roll over in a big way, and they're going to be forced to do the one thing they're not ready, and that's cut. As China banks hold lending rates as the PBOC refrains from easing, but as the spirals out of control, look for the PBOC and other major central banks to cut in big waves, as the new data partly offsets worries over a persistent slowdown in credit expansion, as loans grew at the slowest pace on record in February, reflecting sluggish borrowing demand despite earlier monetary and fiscal easing steps. Well, guess what? They don't get it. They don't understand that people out of work do not want to borrow money, or people that are worried about losing their job don't want to borrow money and consume because they're afraid that they're going to stay on unemployment longer, or they're about to lose their job. And where, of course, credit expansion goes, central bankers, well, they follow. And here you can see commercial industrial lending at all commercial banks is shown on a weekly basis against the federal funds rate in red. And sure enough, as lending demand slows down and decelerates and goes in contraction, what's underneath that horizontal black line, central bankers, here shown as the Fed, respond accordingly by cutting rates. Because when we headed into the cycle, many believed that higher rates were necessary. In fact, that people would want to borrow at higher rates. What did we find out? That that's not the case at all. Nobody wants to borrow at these rates, or at least a declining number of people. And here you can see the evidence. We go into the dot-com bubble. What happens? We see commercial industrial lending decelerate, ultimately collapse, along with the federal funds rate. You see it at the global financial crisis. You see it headed into the pandemic. Remember, the Fed cut rates and everyone was sort of baffled. Well, it was that deceleration in lending that didn't turn around, and now you see it happen again. Commercial industrial lending in contraction. That means that rates are too high, lending conditions are too tight. The only way to turn it around, of course, is to eventually lower rates. And if they don't do it soon enough, as China's about to find out, their whole economy is going to collapse, their stock market is going to go, they're going to yank the world down with it and send us all into a globally synchronized recession. But one company we think will be a huge benefactor is Spectre Holdings, the sponsor of today's show, as they've seen unprecedented demand for their product, as again, countries around the world continue to raise their carbon taxes. And of course, Spectre helps companies lower them in a big way. You can find them on the NASDAQ under the symbol SPEC. We're going to show you why their stock is massively oversold, setting up an initial move of 35% to potentially double in value, particularly as we look to hear from the Biden administration on the toughest ever limits on pollution, could spend the biggest demand that Spectre has ever seen for its stock. And here you can see they're transforming your perspective with real-time emission data, and a lot of companies need that. As you see, they're enhancing their production to 500 units monthly due to unprecedented market demand for their products. In fact, this follows the sellout of the complete pre-sale of their 6-month stock, as everybody wants their product in a big way to save money on these carbon taxes. In a decisive response to extraordinary market demand, Spectre, a pioneer in environmental measurement technology, has announced a significant expansion of its manufacturing capabilities and aiming to achieve production rate of 500 air core units per month by August 2024. And this expansion is in direct reaction to the exceptional demand that has resulted in the complete sellout of its inventory between February and August 2024, which we think is going to be a huge catalyst for their stock as their revenues go up as well as their profits. In an era where emissions reduction is not just a goal but a necessity, Spectre's air core units, notably in the trucking and recently expanded oil and gas sectors, have been reserved several months ahead. To meet this demand and guarantee prompt delivery, Spectre is substantially upgrading its production facilities. And here you can see the announcement that Spectre's entire stock from February to August has been pre-sold, highlights the urgent market need for efficient emissions control solutions. We see Gregory Hankey of MLab, a leading system provider in Germany, emphasize the importance of air core units in tackling real drive emission challenges, particularly with the impending Euro 7 standards. The European market's keen interest in air core units underscores our commitment to providing innovative solutions that adhere to strict emissions regulations, and that, again, is the catalyst that we think is going to send their stock higher off this deep oversold level. Let's take a look at their chart here, and you can see their stock looking back here over the last 10 days came down and held in this supply zone, and buyers stepped in, sent it popping up here, sellers pushed down. And you think about why sellers are here and is sitting in the supply zone. The whole Biden administration is coming out with new standards, and what do we know? The deep pocket investors want to accumulate at low levels, and sure enough, the stock trading right around $1.02 at the time of filming, and in massively oversold levels. The first move right back to that recent high is a 35% move with the potential, as you'll see here, to double in value. Looking back, we know that every time it gets deeply oversold, what happens is stock shoots up into this upper supply zone. It's happened once, twice, a third time as it pulled back in here, and now setting up a catalyst for the fourth move that could send the stock well over to $3. That would be more than double its current price of just around $1.02. We think a huge opportunity for Spectre in your portfolio. Again, on the NASDAQ under the symbol SPEC. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.